Some people might hate me for this, but genuinely, it is honestly a belief that I've seen over the last probably 10 years.
Example, if you have a $500,000 mortgage, interest rates have increased 0.5%.
The name of the game is to buy property and hold it for as long as you possibly can.
Different property owners have a different perception of interest rate changes. Hey Ali, how's it going, mate?
I'm great, Roy. How are you?
I'm good. I see that you still have a smile on your face, although the interest rates increased recently, sitting at 4.1%.
Yeah, well, mate, you always got to have a smile on your face regardless.
100%. That's good. Well, let's just kick off today's topic with a bit of an introduction, guys, for what we actually want to discuss. As you know, interest rates have increased. They have increased sooner than expected, to be fair. And obviously, the elephant is in the room is the actual war that's happening in the Middle East right now, which is affecting your oil prices and energy prices and so forth, which is having a ripple effect on interest rates. So before we get into it, Ali, why don't we share with our listeners for the first time as an example some of the things that we cover in our Monday meeting as a team? Because as you know, we said on our podcast, we're going to be talking about business, motivation, lifestyle, health and fitness, family, but also real estate. So before we get into the actual topic for today, maybe we just give our listeners a bit of an insight of some of the things that we go through on a Monday as a team to help kick off our week and set us up for success.
Yeah. Well, I think that the most important is a bit of a recap on obviously, the previous week as well. But one thing that we kind of do go through quite a lot is, I guess, the properties that we've, purchased over the weeks, the locations that we purchased, the purchase price that we've purchased in. We, like to celebrate certain wins. So, for example, who did the deal of the week? So who got the best possible deal? And we measure that by who bought the deal that's most under market value. We're always making sure that we're keeping on top of, I guess, where clients are up to, where our members are up to. And a big part of what we do is making sure that when clients have completely settled or completed their property, that we're revisiting, we're kind of sitting with them straight away. Again, just assessing kind of their overall portfolio and making sure that things like insurances are all in place and they're getting the right rates, property managements are all done, corrected, and then really doing valuations on those properties and seeing how much equity is accessible and how fast we can move over to our next purchase.
Nice. Okay. So rates have increased. How do we feel about it?
I think it's I've always kind of said two things about this, right? Like, some people might hate me for this, but genuinely, it is honestly a belief that I've seen over the last probably 10 years. And I started buying property back in 2015 or so, when interest rates were relatively where they are today, give or take. And then I've gone through the APRA regulation. Then we've gone through historical low interest rates and interest rates that have climbed 13 times over a 14-month period. And then the signs of interest rates finally reducing, and now they're back here again. So I always say this, as a property investor, you never buy based on interest rates. You never sell based on interest rates. Of course, unless you don't have to, which comes back down to what you should be always focusing, guys, on. What do the numbers look like? Stress test those numbers at, higher, 1 or 2% higher rates than what they are, right? People are, unfortunately, I still hear today about if people go, oh, if rates go up another 2 times, I can't keep this property. And like, for me, that's not a property issue. That's a strategy issue. That's an over leveraging issue. That stuff should never be, You know, if interest rates have gone up one time or twice and they go up another two times and they go up a total 1%, that shouldn't be the make or break for your property. But how I feel about it, genuinely, it doesn't make me feel any different. Of course, I've got my mum's mortgage that I pay for, so that's a non-income producing asset, which is always, that was probably where it hits me the most. But guys, besides that, this is how I've always found real estate. Time and time again, when sentiment is low, maybe due to interest rates, what we find is simply that people slow down in terms of transacting. Now, in saying that, we see a lot of people slowing down putting their property on the market. So our underlying issue that drives property prices, which are supply and demand, don't really necessarily change, right? So if people put less properties on the market because they feel it's not the right time to sell, then ultimately property prices don't have a significant impact because there's just less stock available. In saying that, what you find is when properties do transact slower, or there are less properties available on the market, or less buyer interest, what I find is that most people, especially through building new homes, are a little bit more reluctant to build new homes, not knowing the certainty of where interest rates are going to be over the next, say, 6 to 12 months. When construction stops, rents grow. Every time we saw the most recent slowdown in the market, or the most recent government changes that slowed down the market, what did we see in as a reflection? We saw rental growth historically higher than it has been over the last decade, and that's just purely due to a low supply of new housing. A lot of builders unfortunately going bust after the ramifications of COVID, right? So with new supply, it has caused people to reduce it has caused builders to reduce the amount of properties that are being built on the market. So we're seeing that kind of change, and as you can see there on the graph, we're starting to see even the yearly changes in a lot of these different rents that we're finding, and a lot of them being the areas that have had the lowest amount of building approvals or the highest amount of internal demand, right? You can see Perth at 7%, Hobart at 9%, Darwin at 8%, and even Brisbane at 6%. The other locations that have probably had the least amount of rental growth are, of course, Melbourne and Canberra. Now, both Melbourne and Canberra, if you look at the amount of building approvals that have actually been released for both these markets, they're historically quite healthy, right? There is enough supply happening in these areas. Of course, there are markets within markets. So, you go look at some certain pockets within Victoria, they're currently undersupplied. And those are the areas that we're investing in now. But the majority of the other markets, right, we have started to see stronger average rental growth than we've seen in the past. Now, an average rental growth is around 5%. And you can see there that we've got, 4 out of the 8 markets above that 5% mark. And then the other markets still relatively very healthy as well. So I always find that whenever interest rates go up, I find that my rents are going to grow, and they always usually kind of counteract that. So even, for example, over time, we've seen interest rates at 3%, and then they've gone up to 6 or 7%. But then you go look at that same trajectory or that time frame. What have rents grown since that time frame as well?
That's spot on, Ali. What I found that helps is to quantify the actual concern or problem, right? So for starters, let's just agree that interest rates of different property owners have a different perception of interest rate changes. If you're an owner-occupier, you'll feel the pinch a lot differently than if you are an investor. Let me explain what I mean. For example, if you have a $500,000 mortgage, interest rates have increased 0.5%. So that equals to $2,500 on an annual basis. Now, most property investors out there are going to expect a refund from the taxman at 30%. So if they spent $2,500 for the year, they're expecting $750 back into their pocket from the taxman purely as a tax refund for being an investor, for housing a tenant or two that couldn't afford to buy a home. Now, as you've mentioned earlier, interest rates have increased somewhat around the 5%. So if you had a property renting for $500 a week and it's increased by 5%, that's $25 for that week. So essentially, if you go $25 times 52, it's $1,300 plus the $750 that you are getting back from the taxman. That's $2,000, meaning you're only out of pocket $400 as an investor. So investors have a better cushioning when it comes to interest rates compared to owner occupiers. Okay, so hopefully we don't see any more increases. But considering what's happening in the Middle East right now with the oil crisis that it is triggering, we are probably expecting another rate rise as well, maybe more. Who knows? So why do we think this is happening, Ali? Why do we think that it's not going to drastically affect the property market? Let's have a chat about that.
Yeah, well, I think simply, why are rates increasing, and that's, purely based on inflation right now, right? Obviously, the cost of oil, estimates suggest that it's currently at, what says US $100 per barrel. And that's currently where we could possibly see, once it gets to that point, we could see Australia's inflation to about 4.6%. Now, that would obviously significantly mean we would be in increasing interest rates. And a lot of the big four banks are already forecasting another 25 base points, right? So obviously we got the 25 base points yesterday, takes us to a 4.1% cash rate, and they're expecting another rate rise to come in. However, we've gone in the lab and, we're seeing obviously, interest rates increase because of the cost of everything. And, a lot of people are getting a lot more clued on to understanding that it's not just, petrol or the servo that it affects, but it also affects everything: agriculture, production, manufacturing, everything, all the electricity, everything is pretty much riding on quite a lot. And obviously the Strait of Hormuz, as you know, takes up for 20% of all the world's oil, which is quite a lot, right, when you think of it. And it's affecting obviously other major nations as well. So we've gone in the lab and we've kind of focus on, okay, well, if interest rates obviously rise, as we've shown time and time again, interest rates do not affect property prices as much as people think. I think more than anything, it affects sentiment, but the underlying issue of supply and demand always prevails to kind of show that, this is the thing that is the fact that what's putting pressure on Australia's property prices, and why we're continuing to see growth, and why we continue to focus on the data and what actually makes sense, regardless of where interest rates are, right? In saying that, what we've gone and looked at historical events, right? So historical events that we looked at, which include, different things like we're talking about, the subprime mortgage crisis, back in 2008. You've got things like the Japan earthquake. You have the US-China trade wars early in 2018. You've also had the COVID outbreak. You had the Russia's invades, Ukraine. You've also had, the Israel and Palestine war. You've had quite a lot of different wars that we've had significantly over time, right? Now, these wars have definitely had a significant impact on the global share market. We've started to see, areas, the global share market drop. The Nasdaq has dropped over 5% since the war has started. A lot of the other major shares have actually dropped significantly as well. But guys, with shares, ultimately, I think what we want to talk about is shares are a lot more liquid, right? They transact a lot faster. For me right now, I can go pull out my shares at the moment and have that money in my account by the end of the day, right? Whereas with property, right, and when we look back at these historical events, right, these unfortunate tragedies in war, we've looked at what has happened to property prices, especially in Australia, over that period of time. Now, from 2008, we saw that there were major markets, right, that weren't impacted at all. If anything, from 2008 to 2018, Sydney went on what we would call one of the longest bull runs in Australia's history. Now, we saw certain markets like Perth who were heavily reliant on mining and on exports to these other major countries got impacted, and we saw obviously a major flatline or stagnation in the Perth market. But prior to that or subsequent to that, there hasn't been an effect. Russia and Ukraine again. We saw a lot of, and Roy, you would touch on this as well. Seeing a lot of clients get very scared about what's happening with the war. COVID, another major global event, which I would say probably had a much more significant impact to the Australian economy than what we're seeing today. But we saw property prices prevail. Now, one thing that I always touch on, and I've said this from the beginning, with the share market reducing and people cashing out, right? Everybody is looking for a way, right? Especially with inflation rising and the dollar being devalued, what are people going to do? People are going to hedge their bets and invest into, right, strong commodities. Now, gold, silver, real estate. And for us, real estate is what you can get leverage on, usually what is underpinned by a tenant as well. And then ultimately, focusing on long-term statistics, property prices in Australia have averaged between 7 and 9% over the last 60 years. So I always have seen that, yes, there's probably a little bit of sentiment. I think more than anything that is lower than usual. But when you think of it logically, how many people will be taking their money out of shares, stocks, bonds, right, out of industry supers, converting it into cash and parking it into real estate? Now, if there's that much more money being flowed into the Australian property market, given that this stock market over the last 6 years has been so unstable, right, with all those global events, right? Especially with trade wars and the Russian war and then COVID, you're seeing a lot of the share market be so volatile. So many people we've seen already take money out, invested into real estate. And I think that's a massive contributor to also Australia's property prices over the last 5 years as well. It's not purely just first-time buyers or first-time home buyers or first-time investors that are pushing prices. It's also institutional investors, people with a lot of money, people with larger share portfolios getting out of these markets and investing into real estate. And when you look at the last 10 years of Australian real estate, why would you not be continuing to buy property and investing into real estate? Because it's backed and has had such strong returns for such a long period of time.
All right, so that's spot on, Ali. So why do you think people are doing what you said they're doing? They're taking out money from shares, they're liquidating, but then they're parking them in hard commodities. Let's just talk about, why do we believe that the property market in Australia is a safe haven for a lot of serious investors out there, a lot of mum and dad Aussies who want to set themselves up for the future and essentially set their kids up for the future as well. Why do they feel that property is the right place to be?
Well, historically, property has grown at 7 to 9% over the last 60 years, right? So when we look at property prices, Australia has had very strong capital growth for such a long period of time. We're a growing nation. We have mineral resources, by the trillions. We've got quite a good unemployment. There's quite a lot of infrastructure being built, but ultimately, if you also look at some of these natural or some of these world events, we're far away from a lot of that. Yes, we have certain specific allies, but we are very far away from these things. When you consider, ultimately the safe haven that Australia has, it does present obviously a lot of opportunity. People feel very safe in parking their money in Australia, and I think that's been historically shown by other global partners. People, obviously China. We've had quite a lot of investment from China, but we're also just seeing our natural population grow continuously. ultimately, I think it always comes back down to the opportunity of supply and demand, understanding that Australia has a very, very strong demand for population. I always
Yeah.
talk about there is a major baby boomer generation that will retire over the next 5 to 10 years. So the government has to be bringing in migrants. And we are, as we know, Australia is one of the best places to live, right? All we have to do is open our borders and, we have people, chasing and knocking down the door, right? It's Australia's job to control the level of migrants. But I think that Australia's government has gotten themselves into a little bit of a predicament where we have X amount of people going to retire over the next 5 to 10 years, right? We need, obviously based on the baby boomer generation, we need people to be working and paying, for those retirees through obviously taxes, right? Back when, my mum would work, or back when she was working for her parents, right? There was 5 workers for every 1 retiree. When they go to retire, they'll
Right.
have 2 workers for every 1 retiree. So it's a completely different landscape of future planning that I think everybody misses, which is why we have to consistently bring in the migrants and immigration. We have to continuously bring and build up the population. Now, in order to house that population, we have a target, which we all know is $1.2 million by the Labor government by 2029. And we already know that we are currently on track to have a deficit of over 300,000. Now, just to touch on, when sentiment is low, the last thing people do is want to build houses because they go through a 6 to 12 month construction. So as as you can see here, we do have a major undersupply of houses. So recent forecasts by KPMG indicate that the undersupply of housing will remain consistently severe. Each year, the undersupply of completed dwellings is expected to be in the tens of thousands. I think it will be more. Obviously, leading up until 2030, we're constantly going to be seeing a major shortfall,
Yeah.
right?
I mean, I
And
respect what you said earlier, Ali. You said Australia's performed 7 to 9% per annum capital growth historically. Cool. You know what they say. Past performance is an indication for future performance. But if you want to look, and no one has a crystal ball, but if you just want to look at data, which is what we love to do, what we can see, like you just said, is undersupply of houses. Just not enough houses. There's a shortage there. You said there's population growth, people coming into the country like in record highs, higher than what it was pre-COVID times. There's one thing I also found that I wanted to share with you that I found very interesting. To build a house, you first have to get it approved. You can't just go out there and just build a house. It needs to get approved. So approvals are also not enough. So this graph here from Macro Business is actually hits the nail on the head, to be fair. So this is where approvals need to be. We're nowhere near where we're nowhere near approving houses at the amount of demand that we have. It's just nowhere near where we need to be. Now let's just say all the houses that we need got approved tomorrow, and we were going to build these houses. It's going to take, on average, 12 months to 15 months to build a house. So if we start building all the houses that we need tomorrow, they're not going to be ready until 15 months down the track, and we're not going to fill the gap that we have in the supply chain to house all these people that we have, right? And then let's just say, if we magically get them all starting tomorrow, you're going to need trades to build them. Unfortunately, there's also a shortage of tradies across all states. We're talking about sparkies, plumbers, carpenters, surveyors, etc. There's just not enough people to build the houses that we need in this country. So coming back to what you just said earlier, it's like, yes, 7 to 9% has been historically what the average was. I think over the next few years, we're probably going to see bigger growth than the previous performances purely because it's just red tape everywhere, not enough houses, not enough tradies, not enough land being released, and interest rates have increased, which will mean that people will flock towards more affordable properties, which are the markets that we target for our clients anyway.
Yeah, yeah. It's very interesting you say that. There's 2 points, I guess, when we're going to relate it back to property. A, with what's happening in the global economy, cost of transport will drastically go up. What would that mean from a flow-on effect is that houses will cost more to build. So where does the opportunity align yourself at the moment? Well, the moment there's probably a lot of opportunity in construction at the moment, right? In getting fixed price contracts. But over the next, say, 6 to 12 months, those prices will drastically, I think, increase in value. I think, there'll be an average house would cost around $550,000 to build in the next probably 3 years, right? But that's one. See, with cost of construction going up, less houses are produced. That's just a given. Another thing to kind of touch on as well is that as interest rates affect different markets in different areas, right? Like Roy touched on, we are going into more affordable markets. A $500,000 purchase isn't going to be, someone that can afford a $500,000 purchase isn't going to be impacted as much where someone that is looking for a $3 million purchase, right?
Absolutely.
Is completely different, scenario that we're seeing in the market. So there's 2 types of scenarios, right? Where interest rates, where do they affect and what do they affect? And we've seen that interest rates in the major, more expensive markets are usually impacted. So I know for sure that those that are above the 2.5 million mark, that market is significantly getting impacted. Whereas the 400,000 to 700,000 mark, which is the mark that we generally stay in, that market is consistently having very strong demand. From a lot of first-time buyers that buy below the 5% deposit scheme. Second, a lot of investors that are removing their money from shares and other investments and park it into real estate, right? And of course, the traditional investor that is just looking for something that isn't too high risk can perform and get a relatively strong or strong and average yield to get into the market as well.
Awesome. Ali, before we wrap it up, if you're an investor trying to navigate the 2026 waters, which every week seems to be getting a little bit more interesting and murky, and you're giving your advice to someone who has a home with some equity. They live in Sydney, Melbourne, Queensland, they've done well, they have some equity, they've never invested before. Let's just say a couple, mid-40s, with kids going to school. What would your message be to them?
Number one, plan your cash flow, plan what your numbers, what your repayments look like over a couple more rate hikes. That would be one. Property investment is for the long term, and you've got to have a long-term vision when you're investing into property. So I look at these moments as really big opportunity factors, right? Right now, you might be able to purchase in a very small window properties that have low sentiment at the moment while people are just waiting, reassessing themselves, finding out what they're going to do. We've seen this time and time again. People wait and then people herd, right? And what you can potentially do as a strategy would be, number one, making sure you're maintaining your cash flow and you understand what they look at. But second, add buffers. So for those people that pull out equity, right, they might say want to buy a $600,000 purchase. So they pull out $150,000 to cover a 20% deposit plus costs, right? My suggestion is pull out a little bit more. Add that additional, $50,000 or $30,000 as an additional buffer. Sit it in the offset account. If for whatever reason rates rise and it costs a little bit extra, it can eat into that. You have that additional savings buffer, right?
Yep.
And that allows you to have a long-term position for that particular property investment. And I always go back to the same thing. The name of the game is to buy property and hold it for as long as you possibly can. Right? Through different markets and different cycles, property has performed, as other investments, has performed very, very well over a period of time. But it's, a strategy may be going and speaking to your broker, pulling out a little bit more equity, right? Sitting that in offset as a little bit of a backup. Of course, as you know, you don't pay interest on that money unless you actually start taking it out. So if it sits there for the next 6 to 12 months and you don't need it, then fantastic, right? But if you do need it, then you have it there available. So it does allow you to still get into the market, take the opportunity that we have in front of us right now, which may necessarily mean that there's a little bit of a lower sentiment in the marketplace, right? So you could possibly negotiate a slightly better deal at the moment. And it keeps you in a good position for the long term as an investor. So plan and strategy is my advice, Roy.
Beautiful. Thank you so much for the catch up today. I hope you guys enjoyed today's podcast. Hope you've gotten some value out of it. Ali, I'll talk to you again next time, mate. Always a pleasure. Stay safe, and
Thank you.
we'll talk soon.
See you.